The stock market, a global powerhouse where fortunes are made, industries rise and economies thrive. But how did it all begin? What are its benefits and drawbacks, and how deeply is it tied to the global economy? Let's take a journey through time to explore the fascinating, complex and sometimes controversial world of the stock market. The roots of stock trading stretch back to the 13th century Europe. Merchants pooled their resources to fund risky ventures by trading shares, a way of spreading profits and losses. By the 1500s, Antwerp, Belgium became a hub for organized share trading, laying the groundwork for modern stock markets. But even in these early days, the risks and rewards of investing were clear, a theme that would carry forward into the future. In 1602, the Dutch East India Company revolutionized finance by issuing shares to the public. This marked the birth of the first true stock market. Investors could now own part of a company and share in its profits. However, it wasn't all smooth sailing. Even in the early days, share prices fluctuated wildly depending on the success of trading expeditions. This volatility still exists today, as stock prices can be influenced by anything from company earnings to global politics. The stock market has become a powerful tool for growth, but it's not without its pros, cons, and criticisms. Let's break them down. First, the pros. Stock markets allow companies to raise capital, which drives innovation, expansion, and job creation. For investors, the stock market provides opportunities for wealth accumulation through dividends and capital appreciation. Over the long term, stock markets have proven to be one of the best ways to build wealth, with the S&P 500 delivering average annual returns of around 10%. Additionally, stock markets provide liquidity, allowing investors to buy and sell shares easily. This access to capital is crucial for economic growth, making the stock market a barometer of economic health. But the stock market also has its downsides. Its volatility can lead to significant losses. Events like the 1929 Wall Street crash wiped out billions of dollars in wealth, triggering economic depressions. In today's world, short-term speculation, where traders try to profit from small price movements, often leads to market bubbles and sudden crashes. This type of activity has drawn criticism for making the market less about long-term investing and more about gambling. Another major criticism of the stock market is that it can sometimes widen economic inequality. Wealthy investors who have more capital to invest benefit more from market growth than everyday people. And when stock markets crash, it's often the small investors who are hit the hardest. Corporate greed and unethical practices also taint the market's image. Insider trading scandals and manipulation have led to calls for stricter regulation to ensure a fair playing field for all investors. The stock market is often seen as a reflection of the overall economy, but this connection isn't always clear-cut. On one hand, rising stock prices can indicate economic optimism. When companies perform well, they hire more workers, produce more goods, and fuel economic growth. However, sometimes the stock market can rise even when the broader economy is struggling. For example, in recent years, stock markets have surged while unemployment remains high or wage growth stagnates. This is because stock markets can be driven by factors unrelated to the real economy, like corporate buybacks or central bank policies that keep interest rates low. Today, new forces are shaping the future of markets. Cryptocurrencies like Bitcoin and Ethereum represent a new era of digital assets. Although volatile, their growing adoption hints at the potential for a decentralized financial system, one that operates outside the traditional stock exchanges. Meanwhile, global trends like ESG investing, environmental, social, and governance are shifting investor priorities. Investors are increasingly looking to fund companies that prioritize sustainability, ethical practices, and social responsibility. And let's not forget the influence of globalization. Stock markets are now interconnected across the globe. A market drop in Tokyo can ripple through London and New York within hours. In fact, with today's advanced technology, stock markets are operating nearly 24 hours a day, with trades happening at lightning speed. The stock market has come a long way from its early days in medieval Europe, evolving into a complex, high-speed global network that's closely intertwined with the world economy. While it offers opportunities for growth and wealth, its inherent risks, volatility, and the grey area in its relationship to economic indicators make it both a powerful and unpredictable force. Thanks for watching. Don't forget to like, share, and subscribe for more fascinating insights into the world of finance.